Hello, it is the 7th of February 2011. Welcome to the Silver Log and a quick update looking at the technical analysis. The trendline break most recently is looking more and more of that being a trend in the reversal or trend of direction, as the trend was in a downtrend. That has now stopped. The market is now trading within an uptrend more than anything. You can call the Fibonacci from the highs of 29 31.28 and the highs of 26.30. We are now at a two-thirds Fibonacci test. And if it can successfully get above there and hold, that would make this entire sell-off to be that of a failed move, and we've been in a major trend. This has been the first decent sized correction since the trend has begun back in August. If we switch this up to a 15-minute chart, I've added some upward resistance and support line rather than the ones that was on the downtrend. This is at the exact same rate that the downtrend line was in, and the direction top to bottom also happens to be the same also. But I think if we break this resistance side, that what I'll probably end up doing is I'll probably build up a trend line, most likely at the same rate of increase, which is roughly that around a 4.5% above this line, but it's holding well right now above all of these key averages, which is the 50-day moving average. You have the 5-day moving average, the volume weighted average, the 20-day, the 10-day. 10 days now rising. The 20-day has flattened out, showing that the areas of resistance have turned into this neutral state, moving towards the positive side, because obviously it's uh, it's making the trend for higher highs and higher lows as of this point. Now, this, of course, is what's traded on the COMEX market, the SLV stock market, the LBMA, all of these commodity exchanges, and they're doing it within paper contracts. At some point, this disconnect between the paper and physical markets going to come into another paradigm. I don't know what word I'm trying to use, but when you got people who don't really want to sell because they say, well, I'm getting into physical bullion because I know how currency is made and I want to protect myself through everything that's going on. That's why I'm getting into silver. I've been happy to see the prices to be suppressed lower, have prices well below 30, 20, 25, depending on when it is that they manage to get into the silver. And then all of a sudden, what happens is the dealer supply starts to head south, meaning they don't got much. They're not really able to buy as much because the demand for people wanting to sell just really isn't there. And when that's the case, what a free market would essentially have is a major rise in the price, so that maybe some people who are holding may consider selling as long as the price is up a bit more, upwards to 32, 34, 35, 36, and so on. But from what I'm hearing anyway, a lot of the dealer shops, it's very hard to find your 1 ounce rounds. Even 10 ounce bars are becoming a little bit more difficult. And this is to be the case when you have the difference of people buying the silver and gold and palladium and any of these metals from a price determined from paper contracts. My opinion is that in any of these double digit variables, you are getting fantastic purchases for fiat dollars and because of that, that's what makes it a good play. And if you're not able to get physical bullion silver because the dealers don't have it, APMEX is starting to run low. It goes with the whole action versus reaction issue. Something is going to work within it because of the fact that there's just the silver is just not there to be traded. If you have, say, 500 people who want to buy what's only 70 people got for sale, then 430 people are not going to be able to buy the product because the supply is not there. And that's what it seems we're heading closer towards, is a situation where buyers are far out, uh, being numbered than that of people whom are trying to sell. So sorry for ending in a rant, but I've been wanting to cover the subject just a little bit. Take care, everyone.